My name is Rabea Benhalim, and I'm going to be serving as your moderator for our second panel of the day, which will be focusing on regulatory and business aspects of investment crowdfunding. I'm going to start by just doing some quick introductions. You'll find the longer bio for each of our panelists in the program, but I do want to just give a quick intro for each. So first up is Todd Zywicki. Todd Zywicki is a George Mason University Foundation Professor of Law at Scalia Law School at George Mason University and Research Fellow at George Mason Law and Economics Center. During the fall of 2023, he is serving as a visiting scholar in conservative thought and policy for the Bruce Benson Center for the Study of Western Civilization at the University of Colorado Boulder. From 2020 to 2021, he was chair of the Consumer Financial Protection Bureau Task Force on Federal Consumer Financial Law. In 2021, he was inducted to the American College of Consumer Financial Services Lawyers. He is also a senior fellow of the F.A. Hayek Program for the Advanced Study of Politics, Philosophy, and Economics at George Mason University, and a former senior fellow of the Cato Institute. Next up, we have Allison Herren Lee. She is the former SEC acting chair and commissioner and served as commissioner from June 2019 through July 2022. She served as acting chair of the commission also from January 2021 to April 17th, 2021. During her tenure, Commissioner Lee focused on bringing transparency and accountability to markets on issues related to climate change and other ESG-related information. Prior to government service, Commissioner Lee was a partner at Sherman & Howard LLC, focusing on securities, antitrust, and commercial litigation. A member of the Colorado Bar, she holds a bachelor's degree in business from the University of Colorado and a JD from the University of Denver College of Law, where she was salutatorian, a chancellor's scholar, and served on the law review. Next up, we have Sanjai Bhagat, who has spent over 2 decades in senior finance positions in venture capital, private for-profit companies, and public nonprofits. He has advised the U.S. Securities and Exchange Commission and U.S. Department of Treasury on corporate finance and corporate governance. He is an expert on venture investing, ESG, executive compensation, and cybersecurity governance. Throughout his more than 20-year teaching career, Professor Bhagat has been recognized for excellence in teaching. He was the Graduate Professor of the Year and winner of the Frascona Undergraduate Teaching Excellence Award and Educator of Distinction Award finalist. Dr. Bhagat has served as chair of the university's Benefits Advisory Board that advises the president of the University of Colorado on strategic compensation and health benefit issues. Finally, we have Jonny Price. Jonny leads the fundraising team at Wefunder, which has been discussed several times today, a platform that helps funders raise capital from their community and allows anyone, not just rich people, to invest in startups they love. Originally from the UK, Jonny started his career in strategic consulting at Oliver Wyman before founding the US team at kiva.org, where he led for 7 years. Jonny has a degree in history from the University of Cambridge and has served on the Federal Reserve Board's Community Advisory Council. Take a moment to welcome them all, please.
So I should go first?
Yeah, so the way we're going to format this is each of our panelists will present for about 5 to 10 minutes, and then we're hoping to really have an open dialogue and then open it up for audience questions. So Todd, you'll kick us off.
Well, sounds great. Since this is, so much about this about egalitarianism and that sort of thing. I think this is the first time I've ever been able to go first with the last name, like Zywicki. So that's why I was clarifying, right? It's a different world we live in now, apparently. So it's a thrill for me to be here, and it's a thrill to be on this distinguished panel as well. I'm really looking forward to what these guys have to say. My background is in consumer protection, so I'm going to let these guys talk about a lot of the corporate finance stuff and that sort of thing. But as you heard, I've worked at the Federal Trade Commission, I worked at the CFPB, and so that's kind of what I'm going to talk about in my lens here. And this is a great book. I mean, this is a really powerful, great book. I just want to make that really clear. And I mean that from somebody coming at it from a consumer protection perspective. This is not just a book about investment crowdfunding. This is maybe the best book I've read so far on just how to think about consumer protection in the internet age. Because the way he does this, the way Andrew does this with the focus on private ordering, on the focus on different ways of transmitting information and that sort of thing, it doesn't just have an applicability here. It's a model for thinking about the whole economy and consumer protection regulation, from occupational licensing to you name it. It really is very powerful. The other reason this is a great book is what I love about it is he doesn't wimp out. He doesn't flinch. He takes the argument and he takes the argument to where it goes. He's not sort of kind of doesn't wimp out like the traditional law professor. Well, obviously, we can't go too far with private ordering, right? He draws the lines and sort of says, this is the logic, this is the argument, this is right, this is wrong. I think the discussion he has in the book between information disclosure and primary versus secondary markets is itself worth the price of admission, to kind of go through that distinction about information asymmetries and that sort of thing in primary versus secondary markets. So it's a great book. And I say that also that as a result of reading this book, I am now a new participant in Wefunder. I am basically the poster child for the book, which I'm sitting there reading. It's like, I've heard about this. I should see what one of these things are. So I Google up top crowdfunding sites, and Forbes or some other credible source comes up and says, I think it said something like easiest to use. I was like, that looks like the one for me. And it was Wefunder, right? And I looked and I saw in the book it was in here. It's like, all right, he vouches for it also. Landed on the page, and now I'm the newest investor and brand ambassador for Oak and Eden whiskey. It is exactly as Andrew said.
It's working.
It's working. They're going to raise, so they started on September 1st. They're going to try to raise $10.6 million, and since September 1st, they've raised $9.5 million. $9.5 million on this crowdfunding site from this. And it's got everything he says. It's got a pitch deck. It's got a video from the guys. I put it on Facebook. I'm an investor. All of a sudden, I start getting into my Facebook feed. I asked the guy a question on Facebook, and like 5 minutes later, he responds. I was like, about like bottle, like getting specialized bottles or personalized bottles. So I'm going to solidify my role as son-in-law of the year by getting my father-in-law a bottle of Oak and Eden whiskey with his name on the label. So, the whole thing is just fun. It's interesting, and I think I'm going to make some money off of it also. So, so it really is a great smooth sort of thing. So let me just make 3 points substantively beyond urging all of you to go out and buy Oak and Eden whiskey, which it turns out the next thing I did was Googled up, where can I buy Oak and Eden whiskey in Boulder? And I found the place, and now I have it here. So, because my perk doesn't vest until, I don't get my perk until the, makes its numbers. So, yeah, so I couldn't wait that long. So I want to make 3 points about why I think this is such a profound book about consumer protection and consumer financial protection, and why it deserves to be read by anybody who's thinking about consumer protection, not just this. The first is that for a long time, the basis for most consumer protection regulation has been asymmetric information. And it's clear that, and occupational licensing being the good example, right? It's clear that that is a very poor way of regulating things. Disclosure, sort of mandated disclosure, is also a poor way of doing things. It's the worst way of doing it except for every other way we could think of in the past, right? Now we have a much better way, and he lays it out, right? The internet, the information economy, the reputation economy, all these sorts of things, we're getting increasing evidence that this is much more powerful and more useful to consumers. We've always understood that when the market drives disclosure, it generally drives disclosure towards the things that consumers care about, not the things that bureaucrats think consumers should care about. And that's what we see here, right, is it's providing information in a useful way to consumers. And it's just something that consumer protection attorneys simply have not, and thinkers have not really internalized. And what we see here is a new market, and it's really quite remarkable that the regulators haven't screwed this up already. That they have done a pretty good job of letting this market exist and thrive. And so I think this point about and there's some studies on occupational licensing, for example, that show that consumers don't really care about government licenses. What they care about is your rating on Yelp and that sort of thing. So consumers are using this information already. This really explains the logic of it and explains why the internet can be such a powerful tool in this area. The second thing I like about this is something I've been talking about a long time, is we could think about consumer protection regulation as a three-legged stool, which is we've got markets, common law, and then regulation. Regulation is the lumpiest and kind of most ineffective way of dealing with most things because it's one size fits all. It takes forever to do it. It's subject to all kind of public choice pressures and the biases of regulators. But that has become the default, right? That's become the default way that we think about solving problems, consumer protection problems and the like, rather than and it should be the last resort, not the first resort. Right? The market itself is the most effective way of protecting consumers, which is advertising, reputation, repeat dealing, all these sorts of things. And the internet now makes this much more powerful, starting with markets. But the other thing that's very prominent and tends to get lost, I think, in the discussion, and Andrew mentions it, he doesn't go into a lot of detail, but the simple old rules about fraud, contract, tort, right? The common law is another way of providing consumer protection, warranties, anti-fraud, that sort of thing. And he keeps reminding you through the whole thing, it's like, dude, there are anti-fraud laws out there that are still available to consumers and that sort of thing, in addition to the other private ordering mechanisms here. And so I think he's very calibrated about start with the market, figure out how far the market takes us, think about what the market failure is, think about whether the common law solves that, right, through contract and that sort of thing. And then what's left over at the end for regulation, and I think he makes a very compelling case where regulation can come in, how it can be useful, and the like, while allowing those other sorts of more flexible ways to flourish. The last thing he says, and I'll close on this point, which is, again, just a great point, and I applaud him for not flinching when it comes to the implications of his argument, which is there's two ways you could think about this from a law and economics perspective. You can think about loss prevention, right, or loss mitigation, right? And a point he makes that I think is a really powerful point that I've kind of thought a lot about is he says, one of the ways of dealing with this is to simply limit, rather than trying to prevent every idiot from losing money, right, if they do something stupid, another way is just limit the amount that people might end up losing, right? Which is that there is a cost to all this regulation, and we just pile these regulations on consumers, trying to keep them from ever making a mistake. And sometimes it may just be, we know, for example, one of the way consumers learn about bank accounts and that sort of thing is by making mistakes, right? We make mistakes early in our life, but they're small mistakes and we learn from them, right? And so there's a dynamic process there. And so I think the idea, he says, one of the points he makes is just limit the amount that people's exposure is, right? And people will learn from it, markets will learn from it, and that sort of thing. And don't treat people like children, thinking that we can always keep them from losing money, right? You can go out and you can buy $1,000 pair of loafers, but you can't go out and buy, make $1,000 investment in Oak and Eden, right? Which you actually get something for it, at least I hope, at the end of the day, right? But we kind of have these worlds in which we just ignore the reality, right, that people can spend their money on a lot of different things, and there's nothing fundamentally different here. And we don't limit how much people can spend on a handbag or a car or something like that, right? And so here we've even got more protections in place from that, and you might actually make some money off of this. So anyway, it's a great book, and I'll close there.
I would just like to acknowledge that was perfectly at 10 minutes.
Oh,
well
thank
done.
you.
Allison, please.
Sure, and I'll probably give back some of my time because I want to be brief and get to the Q&A and the discussion, which I think is always more interesting. So I'm a former regulator, and I view these things slightly differently from Todd, although I will say that the last point, I'm 100% in agreement with, and it is the single, in my view, most important protection that we have in the regulation crowdfunding space, and that is that investors are required or prevented from investing over a certain amount. There's a cap on what they can invest. And I think that is what gives me comfort in the space. I think it's important at some level, and we can have this discussion, but there are some fundamental differences between consumers and investors. That's why we have the Securities and Exchange Commission. Investors are expecting something and they need something. It's important. They're building savings. They're building for retirement, for their kids' college and the like. They're not buying an expensive purse set, which they might do. But what they're engaging in, the conduct they're engaging in, is fundamentally different when they are investing and looking to get returns on their hard-earned money. So I think we have to, there are certainly some important parallels, and then there are some places where I think that the analogy doesn't work as well. Here's what I'll say. So I am a big fan, believe it or not, with that intro, of crowdfunding. I think it's very important. It came in the Jobs Act in 2010. I was supportive of it then, and I was supportive of it when the Commission first came out with the regulations in 2015. Why? Because it is one of the very few, first of all, it capitalizes on the internet, which is just, profoundly important, and very difficult in many ways to do in other areas of finance. And then secondly, it really does help those micro businesses get started, and helps people understand how can they possibly think about raising money, and that. And there are very few other spaces where some of these really small operators can have a chance to raise money. So I think it's an important regulation. That said, it is a regime that allows what we call retail investors to invest. You were saying, you can't spend $1,000. Actually, you can spend $1,000 on an investment through regulation crowdfunding and more, depending on your income. So I think it's profoundly important regulation, but I think you have to also think about markets so there is no such thing, frankly, as an investment market that is completely free, if that's just market driven. If there are no rules, there's no market. There have to be rules. So the question is, what rules? How, and how do you weigh them? And reasonable people can and do differ on how to strike the balance between how much regulation you need and how much investor protection you need. That's not an easy, there is no one single answer to that question, but it's one that is constantly worth thinking about and engaging in, and one that I spent many, many years thinking about as a commissioner at the SEC, and before that as an enforcement lawyer, when I see firsthand what happens to some of these investors who do get bamboozled out of their life savings literally at 80 years old and have to try to go find a job at Burger King. I mean, I've spoken to those people. And so I think it's important to keep both of those sides in mind. Every time you're adding something that is there to protect investors, there's a cost. But every time you take it away, there is also a cost that is less visible to many, but very visible to folks like me who spent over a decade doing enforcement work. So all of that said, here's what I'll say. I think it's an extremely important regulation. I think it's something that the SEC should pay more attention to rather than less. They have not done a lot of data analysis in this space. That's why, and I should have led with this, I do just think Andrew's book is fabulous, and I highly, highly recommend it. It's an in-depth data analysis, in-depth ideas, and I agree. I really appreciate it when academics will just say, here's what I think should happen, as opposed to maybe on one hand this, on the other hand that. I think it's quite useful and quite helpful, so congratulations to you, Andrew, on that. And I think I'll stop there and just look forward to the discussion and any comments or questions.
Thank you.
Thank you. So I think you've heard, two perspectives, or at least two sets of ideas. And I think they're both excellent. I think both Todd and Allison gave a very excellent exposition of what they think are critical issues with regard to crowdfunding or investing in more broadly. So I'll take a somewhat different slant, more of a finance, investor slant. The issue is, what kinds of crowdfunding efforts are likely to be more successful. And Jonny may actually have some real data or experience, but I'm sort of relying on the data that we have so far analyzed. So what we see is that in those crowdfunding efforts where the founder or founders retain a larger fraction of the equity, they are more likely to succeed. Now, crowdfunding is sort of not, I think as has already been highlighted, not the only way investors can invest. I mean, here the dollar amounts are small, the overall dollars are small, but it's an interesting market. We then move on one step higher to the IPO market. If you want to understand, which IPO will get valued more highly, given the same, if you look at two IPOs in the same industry with roughly, let's say, the same asset size, one IPO may have a much higher valuation than the other. And again, the reason is if the insiders, meaning the CEO of the company, the VC, if it's VC backed, the directors and other large investors in the company, if they retain a larger proportion of the overall size of the equity of that IPO company, that IPO will have a higher valuation. We've shown that with US data, it also applies internationally and applies over time. So if any of you are fortunate enough to get close to an IPO, your company is getting close and you're wondering what you can do, don't sell your equity. And recommend that to your other CEOs and board members also to not sell. Investors will value that more. Now let's go a level higher. Publicly held companies, very large publicly held companies. If you are looking for one variable that will explain how well a company is governed with respect to investor interest, that one variable is going to be the equity ownership of the median director or the average director's equity ownership. How invested are the directors of the company in their own in the stock of their own company? If they have a higher level of equity ownership, those companies perform better over time. So that's sort of the broad landscape to understand. It's that old thing, if you have more skin in the game, you pay more attention, usually good things happen. And sort of, nobody was expecting to hear about Silicon Valley Bank today, like crowdfunding, like those are worlds apart, but not really. So Silicon Valley Bank, of course, funded many startups and tech companies, so there's one connection. But what I wanted to highlight with this equity ownership and how it might help you predict which companies will do better. It's the same story with Silicon Valley Bank, First Republic, Signature. You hear a lot of media stories as to what went wrong, and some of that is superficial. These companies, the duration of the investments were misaligned with regard to their assets and liabilities. Essentially, they were getting overnight deposits, investing it in longer term treasury bonds, mortgage bonds, so there was misalignment. But that's superficial. Now, why did that happen? Look at what the CEO was doing for each of these companies 3-4 months before. They were selling tons of equity. I mean, they knew there was a problem with their banks. They were bringing down their equity ownership in their banks. Now, of course, everything they did, the CEOs are allowed legally to sell stock at certain time periods. But every time I see a CEO selling a large amount of stock, usually something bad happens. That same bad, I've seen this movie before. Let's go back to 2008. Look at 2-3 years before that, at all the CEOs of all the big, banks that were too big to fail. Same behavior. You find them selling. Back then, of course, those were CEOs of much bigger banks. They were selling equity on average worth $60 million each. here, the equity amount was less, but you compare these three banks with other banks of similar size, they sold significantly more. So that's one thing that always predicts when you will see a problem. We can talk more about, I can talk some other aspects of equity crowdfunding, but I think Jonny may get you some more insights, better insights perhaps.
I don't know about better, but yeah, hello everyone. Jonny Price here. I am from England originally, as you can probably tell. These days I live in Nashville. Moved there a few years ago from San Francisco, where Wefunder is based and where I lived for 10 years or so. I wanted to start by just talking a little bit about Wefunder's mission. So we're a public benefit corporation. You guys may know you can incorporate as a C Corp, or an LLC, or an S Corp, or a PBC. And a public benefit corporation is not obligated to maximize shareholder value like a C Corp is, but it's obligated to uphold its charter. And if you go to wefunder.com/charter, you can read our PBC charter. For me, what our charter is all about is kind of three things. The first is getting more capital flowing to startup founders. And our founders founded Wefunder back in 2012. They're actually pretty influential in getting the Jobs Act through Congress, and we're in the Rose Garden with Obama when he signed it into law. Then took a few years to be rolled out, and as we've heard, and you guys probably know, May 2016 was when the Reg CF rules were rolled out. So since then, Wefunder has been the largest Reg CF platform in the country, but a big part, I think our CEO Nick's probably the biggest drive of him, of why he started Wefunder and what our PBC charter is about, is getting more capital flowing to startups and entrepreneurs in America. And it's interesting that the context, the historical context of the Jobs Act was post-2008, the crash. The recovery was slow. We needed to get more capital flowing to entrepreneurs. And one way to do that was to unlock the power of unaccredited investors, retail investors, to invest in entrepreneurs. So for us at Wefunder, we think entrepreneurs are cool. We think more people starting companies, like being able to get the capital they need to launch, grow companies, is a good thing for the vibrancy of our economy and society and for the communities we live in. We do Main Street businesses on Wefunder. We do bars and restaurants and breweries and distilleries like Oak and Eden, as well as tech startups and biotechs and movies and soccer teams. It's really cool, the diversity of companies on there. But so getting more capital flowing to founders is a huge part of why we exist as a company. And if you look at the trends around entrepreneurship in America, I think COVID has actually bucked these trends. Because maybe people were at home and decided to start businesses. I think for the first time in decades, there's been an uptick in entrepreneurial startup activity. But over decades, there's been a big decline in the number of people starting companies in America. And so for us, what we're doing with Reg CF and Wefunder investment crowdfunding is about trying to change those macro trends. And not just the aggregate amount of capital flowing to startup founders, but also if you disaggregate, I think 1% of venture capital today in America goes to Black founders. I think 1%, similar percent goes to Latino founders. I saw a stat that 2.2% of venture capital goes to female-only founder teams. You want to guess what that is for male-only founder teams? 80%. If you look at it geographically, I think 80% roughly of VC is concentrated in 3 states, California, New York, and Massachusetts. And so a part of what we're trying to do as well is to say, if all of the people deploying venture capital dollars are white men that look like me in Silicon Valley, then maybe that's part of the reason why, not all of the reason, but maybe part of the reason why, white men in Silicon Valley are getting a very high share of VC funding today. So if you can empower women of color in Nashville or Colorado or Columbus, Ohio, or wherever to be angel investors. And it's not just VCs. If you look at the profile of angel investors in countries like overwhelmingly men, overwhelmingly white, and also kind of similar geographic concentrations, it's really hard to raise capital if you're a woman of color in Louisville, Kentucky. And so we have a partnership with a VC in Louisville. They're really excited about what we're doing. And if you look at the number of angel investors investing in startups in Louisville, they're really excited about Wefunder's model is massively increasing that number, which then hopefully can get more capital flowing to startup founders outside of those 3 states that I mentioned. So that's good on the founder side. And then on the investor side, as has already been discussed, and really enjoyed the discussion, actually. I look forward to diving into that more. But on the investor side, I kind of joked about this in the intro that Rabea read, but why should only rich people get to invest in startups? There's very, very valid kind of arguments on the consumer protection side, the other side. I also love that the SEC has a limit on how much investors can invest. So any of you guys, irrespective of income and wealth, can invest $2,500 per year in startups through Wefunder or a Reg CF platform. And then depending on your income and wealth, that goes up, but it's capped. And I think that cap is a really good thing. But yeah, like a lot of wealth creation over the last few decades has come from Uber's IPO or Google's IPO. And no retail investors, no middle-class Americans got to participate in that. Maybe indirectly because, pension funds or LPs in VC firms. But for the most part, like the people benefiting from that wealth, explosive wealth creation are kind of accredited investors. And I wonder if to some small extent, like, is this, if a lot of wealth creation, probably more wealth creation in the last 2 or 3 decades has come from companies in private pre-IPO, and companies used to IPO earlier, so more of the wealth creation was post-IPO, so retail investors could get to participate. But if more of that wealth creation is coming pre-IPO, if the only people that can get to play in that are rich people, is that one kind of small contributing factor to worsening inequality that we've seen in this country over the last few decades. So that's the second point around kind of investor access and letting ordinary people invest in startups they love, founders they believe in. And then the third one is just around kind of some of the stuff that Todd was talking about with Oak and Eden, actually. Like, we think it's cool for, especially for consumer-facing businesses, and as Sanjai was mentioning, like, I think the best fit, sweet spot for Reg CF and community rounds is consumer-facing companies. But for those consumer-facing companies, if you can turn your customers into owners and investors, then they'll become your brand ambassadors on a panel at a university law school in Boulder and tell all the audience to go and buy Oak and Eden whiskey because it's a great brand. So that literally that was like beautiful poster child moment for the whole idea of what we're getting at here. So more people getting to participate not just in the economic upside but also just like in the journey. Like more people participating as angel investors, investing in their community, not parking their money on Wall Street, like not parking their money in Starbucks, but investing in the local coffee shop. And we think that's a good thing. And just on the investor side, more people kind of participating in startup journeys and investing in their local communities. We think that's a good thing. So that's kind of what our PBC mission is about. How am I doing on time?
You did that 2.5 minutes.
I was going to say something else, but I don't think I'll have time, maybe at the end. The last thing I'll kind of abbreviate it. Looking forward, we're pretty excited about this way of raising money because if you look at the trends in a number of different industries, there's this word democratization, right? So Uber is the democratization of taxis, Twitter is the democratization of journalism, Airbnb is the democratization of hotels, and you see a lot of industries kind of moving this direction with the internet. And it's pretty anachronistic to me that the way that technology startups raise capital today is one, you can only from rich people, and two, only in private. And again, there's very good reasons for this. The consumer protection it's really important to keep in mind, but it does seem anachronistic to me. It seems like a future where everyone can participate democratically, and we're using the internet to be able to kind of share the investment opportunity widely. Just seems like a trend that we're on the right side of. I kind of tongue-in-cheek posted, I think on LinkedIn a while back, that venture capital investors gleefully disrupted the hotel industry and said, and some people said, Hilton said, well, you can't, no, not anyone can be a hotel owner. We have to be the hotel owner. No one's going to go and stay in, an Airbnb. But the VCs said, gleefully invested in Airbnb, said, no, anyone can be a hotel owner. And then, Uber came along and people said, oh, no, not anyone can be a taxi driver. You have to be a trained professional to be a taxi driver. And Uber came along and said, no, anyone can be, and the VCs gleefully invested in Uber and said, no, anyone can be a taxi driver. And you can run it Robinhood in the public markets, right? Like VCs gleefully invested in Robinhood. When it comes to Wefunder now, sometimes the skepticism from VC is like only we can make these investments. But our perspective is no. Let's open it up. Let's let everyone invest in startups they love, and yeah, that's what we're about as a PVC at Wefunder.
Okay, thank you. Before we jump into questions, I also want to give my plug for the book. As someone who writes law review articles, partially for my living, I am sympathetic to those who might be wary of something written by a law professor. And I just wanted to say that it was with great joy when reading this book, and also sort of inspiration, that the sheer accessibility of the way it is written and the way in which it is laid out. And so for those of you that have sort of said like, yeah, this seems interesting, but also I'm not sure I want to read a law review article, so it's not a law review article of writing. It's very, very accessible, and it really lays out things in a way that I found, even if someone know nothing about this, and obviously walking away from today, you'll know quite a bit, really builds the ideas in a lovely way. So I just want to put in my own pitch. Todd, I want to start us out with questions. So as you told us, you have recently become a crowdfunding investor. And I was hoping you could sort of share a specific part of that experience, which is the book talks through this idea of private ordering, maybe not versus government regulation, but at least as an aspect of government regulation in terms of building trust and protection. And what we mean, for those of you who have not read the book yet, in terms of private ordering is, right, the ways in which those on the internet get information and also send different signals as to the potential reliability of an investment. I personally was sort of delighted at the idea that Google stalking, I don't know if you're all familiar with it, like, where you just go on and try and find out as much, that Google stalking could have a real upside and benefit to the world. So I was just hoping you might share sort of your own experience as someone trying to make these determinations as to the impact of private ordering and government regulation on the decision-making on your end.
Yeah, first thing, which is one of the things I thought about, and Jonny mentioned, I think, Louisville, people in Louisville. The first thing I thought when I was reading the book, it's like, oh, I've heard of crowdfunding before. That's what they did with Muhammad Ali. All right, those businessmen in Louisville got together and basically did crowdfunding of Muhammad Ali's career, but they just happened to be a bunch of local businessmen. This is just Muhammad Ali writ large, right? I don't know if you know the history. He had like of Muhammad Ali after the Olympics didn't have any money, and so businessmen got together and pooled their money so he could train and get a trainer and all this sort of stuff, and then they got a share of his earnings. But yeah, so it was kind of a funny story, which is I was reading the book and I was a couple chapters in. And I thought to myself, well, I just had to see what this thing is, right? And so what ended up happening was, and doing it as I was reading the book, and what I discovered as I got deeper into the book was everything that then Andrew diagnoses as the things that worked for me is actually what worked for me, right? So I go in there and what you see is it's very, it's a product I like, right? I understood the logic. I like whiskey, right? It seemed like fun. There was a lead investor who right up front said he had previously invested, I don't know, $300,000 or something, and he was investing like 75 or something in this round. And then like his mom and dad chimed in and said, we're his mom and dad, and they really believe in this, right? And so we're investing, right? So it was the lead investor that he talks about. They had a slide deck that explained it. They showed everything that they were doing. And it was just like kind of one of these things. It's like, I get it, right? You know, they had a storefront down in Fort Worth. Here's their plans to expand. I said, that makes sense. People will like that, right? I would go to that kind of thing. I know there's a market for this sort of stuff. So it's kind of one of these things where it just kind of made sense to me. Interestingly enough, while I was sort of goofing around, I thought, well, kind of be fun to own a part of a soccer team. Right? So I looked around and I came across, frankly, a pretty amateurish presentation for a soccer team that seemed a little bit dicey. And I was like, I'll wait before I invest in the soccer team. But right, these guys had their act together, right? And it just gave me confidence. And there were a lot of people there. There was the lead investor. There was the website. I interacted with on Facebook, right? They just, it's like kind of one of these things where it's like, this gives me confidence and it's product that'll be fun. And it's like one of these things that I'll be, both the consumer and an investor kind of thing. And so, but you have to use some judgment, right? But it felt very easy to me, so.
Thank you. Allison, my next question is for you, which is, you talked about the importance of some of these regulations. And I was just curious, and you talked a little bit about which regulations you think are the most important. I was curious if you have any perspective or opinion on what direction you would like to see regulations take in the future.
Sure. Specifically with respect to Reg CF, which again, the commission voted on that initially in 2015. I think it didn't become effective until 2016. And then there was a revisit of that in 2020 where they made some additional changes, raised the ceiling on how much issuers can raise in a year and a few other of those things. There were some missed opportunities, I thought, at that time, and a couple of them were the commission did not at that time do a deep dive on the data that was out there. They didn't scrape data from crowdfunding portals like Wefunder, which is just a wealth of, I'm sure, great information. I too went on to Wefunder and signed up. I haven't invested yet, but I probably will.
We'll work on
Yeah, it's only because I didn't have time to go through it was a really great experience, and I'm sure I will invest something there. But what we didn't do at the commission in 2020 when we made changes was really, in my view, a thorough enough economic analysis to understand how well the system is working. But we don't. It's not as though we have an abundance of evidence to suggest that it's not. But we do have, and Andrew, I noticed in your book, you pointed out that there was only one SEC enforcement case thus far, which I think was in 2021 when I was still on the commission. And I remember noticing it as well because it was unusual. I don't think it's because of full compliance by everyone in that space. I think it's more because the staff, these are very small, in general, very small cases, and the staff has to triage its time. And so they have not focused as perhaps they might in other spaces where the losses are a little higher. Now, let me back up and say, what do I think should happen in the space? I think it's in a pretty good place. I do think we should have done a better analysis at the time of the changes in the rules, and I take great comfort from the investment cap. To me, that was almost all I need to know. I'm like, that's fine. Let's experiment, let's see what happens. And for the most part, what we know is that retail investors will be their losses will be limited. The problem too, though, is it's not just their losses that are limited. Oftentimes it's their upside as well. That is a place where I think we should have looked. And that's the one area that I think deserves some more attention. The problem is you don't get the regulatory gears in action over one little issue. There needs to be, I think maybe the smarter thing to do would be to wait a few years, really gather some data and figure out whether some additional changes need to be made. But one thing I think we should have looked at the time in 2020 was these SAFEs, Simple Agreement for Future Equity. And I don't know if y'all are familiar with this in general, but it's a form, and it sounds like perhaps that's what you might have invested in. And I'm not saying it's bad. I'm saying it's complicated, and not everyone understands it. And what can happen there, of course, is that, and it's a very common feature of some of these crowdfunding offerings, and it can prevent. So when you say, Uber, everyone, made all their money before the IPO. And if only they could have gotten in earlier and held on. That's not the way these cap tables actually work, right? They don't. You will get taken out. You will get diluted into non-existence practically, or taken out before those huge returns are. In general, that's almost always what happens, and the SAFE actually facilitates that. So I think we should have looked at whether to preclude those or maybe put some additional guardrails around it, something to make sure people understand when they're buying in to an investment, they're not actually getting equity in that moment. They're not shareholders. They don't have a vote. And so that piece, I think, is one piece where we should look at it. But I'd also like to see the commission do a deeper dive to understand maybe some of the regulations could and should be loosened. Maybe some should be strengthened. We haven't done the kind of data analysis that I think would warrant that type of work.
Can I just chime in? I agree with that. That's what I found to be the most complicated or difficult part of figuring out what I was doing, which is how does the back end on this work is still kind of pretty opaque to me. So
Can I come back on that actually? So on the safe, the safe doesn't actually preclude you from, like, you can't get pulled out in future rounds. The safe is a good example for me of a really interesting trade-off, I think, that I wanted to actually get your take on, Allison, around investor protection versus the more regulations or burdens that you put in, burdens and regulations, it can lead to a problem of maybe adverse selection, you might say. SAFE is a really good example. Partly the reason I came back is we lobbied the SEC. Our CEO wrote a letter to say, please don't take away the SAFE. Yeah. So Nick, our CEO, wrote the letter. I think our competitors were pushing for a SAFE to be not allowed with Reg CF. Every company coming out of Y Combinator, which is the best accelerator in the world, apologies to Brad Feld if he's in the audience, but YC, great accelerator. Everyone's coming out of YC and raising on SAFE. And so our CEOs, and I think our position with the SAFE is, if you ban the SAFE for Reg CF, every company coming out of YC, you're precluding them from going on Wefunder, if that's the instrument that they're raising. And this is, VCs are investing in SAFEs, right? Angels are investing in SAFEs. This is like the go-to industry standard for kind of seed rounds, early stage rounds, before a VC comes in and runs a price round, sets a price. And it's, very quick, kind of cheap legal document, saves the founder a ton of money on legal fees. So the trade-off, I think, is a really good one, right? It's like, do the retail investors really understand that this SAFE doesn't convert to equity unless there's an exit or a follow-on financing round? And yes, they're not getting equity, but it's kind of, it's de facto equity. Like when a VC invests in a SAFE, it's like they're seeing it as an equity investment. So there is that kind of investor protection concern. But against the adverse selection thing of, if you ban a SAFE, then all these really awesome companies, like the best startup companies, might then not want to open up a community round. And the other example I think of with this is carried interest. And so I believe that the reason why lead investors, like Todd, you mentioned the lead investor in the Oak&Eden deal. I really love this product feature that we came up with at Wefunder, where every deal now on Wefunder requires a lead investor who's investing a meaningful amount of money, typically 5% or more of the round. And the amount they're investing is public, like you saw, 75K this round, 300K previously. And I love this because one thing we've learned over the years at Wefunder, you can't only rely on the wisdom of the crowd. That needs to be complemented with the wisdom of experts. Because if everyone is doing 5 minutes of due diligence, no one's kicking the tires. And so having a lead investor who's really going deep and investing a larger sum of money and is an expert and kind of helping to set the terms of the investment, they kind of complement each other really well. But we would love for lead investors in Reg CF deals to be able to earn carried interest on the full amount. This is how it works on AngelList. If you run an AngelList syndicate in Reg D, the syndicate lead can basically earn, I think, usually 10% of investor profits. So if the investors invest $1 million in the syndicate and the company 10x's, so everyone makes $10 million of profit, the lead investor for bringing that deal onto AngelList and giving the investors this investment opportunity can get 10% of that $10 million, $1 million of carried interest upside. And I think the SEC rationale, which is again very fair investor protection, not wanting to tax retail investors with this kind of rather complex carried interest that then if the exit comes down the line, like, oh, there's a tax on my profits, like what is this carried interest thing? I think it was motivated by investor protection. But our position is, if lead investors could earn carried interest, then rather than right now, lead investors are really economically incentivized to put those deals up on Reg D, where only accredited investors could participate, like on a platform like AngelList. If the lead investors could earn carried interest, they would be much, much more economically incentivized to bring these awesome, high quality deals to a platform like Wefunder. And so the quality of the deals on the site then might improve. And so there's a real interesting tension between kind of protecting investors versus adverse selection or attracting quality deal flow. And the other example there is the financial reporting requirements, which I actually am a fan of, right?
So if you raise more than 124K, you need a CPA review of 2 years of GAAP financials. If you raise more than 1.235 million, you need a CPA audit of 2 years of GAAP financials. And again, it's great because retail investors, they can see this information. It's been signed off on by CPA. So you know these financials are real, and you can't have the wool pulled over your eyes by a nefarious entrepreneur raising capital. But again, the biggest impediment right now to world-class venture-backed founders that don't need the money, that they have people throwing money at them, the biggest reason they don't do Reg CF is because they need to publicly share financials. And if you raise through Reg D and accredited investors only, you don't need to share your financials. And so, again, I'm not kind of advocating for the removal of those requirements, but I think it's just a really interesting trade-off between investor protection and kind of founder adverse selection.
I do. I'll tell you, though, I think some of the concepts in the VC and angel investing space don't translate as well to retail investors. So lead investor is another good example of that. These are not really fiduciaries. They're not people whose job is to look out for the other people who come into that deal. And the same thing with safes. Of course, it's true that that's a vehicle that works quite well in Silicon Valley. It doesn't translate as directly to retail investors. And let me just say, when we say retail investors, we're talking about a defined term. That's not a term of art, but that's usually the term people use. But what they mean is non-accredited investors. And non-accredited investors, this notion that if you're accredited, it's only rich people that are accredited, that's actually not right. You know that, right?
Yep,
because,
yep.
I mean, you can be, so 200,000 in income, that's a sizable chunk, but the other way to get in is $1 million net
Household wealth.
equity. Yeah, and people who have spent their entire life saving have those. That's a very common amount. You could be a postal worker and have spent your entire life putting your money away. So I just don't think those concepts translate as cleanly. I take the point that if they were to prohibit safes, you might see some change. I don't think you're saying we therefore ban anyone from coming out of that. They will have to make their own decision. Do I want retail investors or not, right? It's not as though it operates as a direct ban, but I just think it's important to think about some of the Silicon Valley concepts that work quite well for the sophisticated folks in venture capital, and even angel investors who can also be quite sophisticated, as you know, don't necessarily translate as well to everyday retail non-accredited investors. And I had to spend myself, I've been a securities lawyer for 25 plus years, just trying to understand what a safe was and reading through one of those contracts. It took me a week. To really understand, okay, I think I know what's happening here now. I think,
A safe is 3 pages, right? And a typical price round contract is about 60 pages.
I want to jump in real quickly.
A typical equity price round contract is 60 pages.
Right,
So in terms of
And
the
a
legal
prospectus
contract that the investor's signing, safe is a lot shorter. Right?
I want to ask a follow-up question, which I think is related, which is and I don't know that any of you will have the answer to this. But one of the curiosities I had when reading the book and also listening to this conversation is how much is investment crowdfunding an emotionally related decision? So is it an emotionally related decision, and that the emotional feedback is actually what you're getting out of it, insofar as there's this idea that you could have the dream of, I don't know, becoming a billionaire, right, or extremely wealthy in the United States, and there's been a lot of conversation in the larger political and social sphere around this shift of the American dream to maybe just the dream of being ultra wealthy. And so how much is investment crowdfunding just allowing investors to have this emotional fulfillment of the possibility of this dream versus it actually being a sincere investment, something that investors can expect to get a significant ROI on? And I was wondering if anybody knows, in aggregate, how it compares to, say, just going to the stock market and investing in stocks.
Can I ask, and maybe this is a question for Jonny, versus, when I look at the website, what I see is a lot of people basically giving money to things and they don't care whether they make money.
Yeah, that's
right. With like a lot of these environmental products, like there's this one that I'm not going to invest in, where you can compost your body when you die, right?
Is that called burial?
I don't know what it's called, but they're raising a lot of money for it, right? And when you look at all the comments on the board, it's basically these people who are giving money, they start giving it because they think they're going to it's going to be part of their estate when they die, to put it another way. But a lot of these things just seem to be sort of not emotional, but they're not really doing it to make money. It's a way of essentially giving charity. Do you know how many people are animated by that?
Yeah. By the way,
Please, Sanjay.
yeah.
So give a more, what I'd say, broader perspective on this and your question. So in finance investments, we talk about individuals making two types of decisions. Investment decisions, as in investing in fixed income, treasuries, stock market, real estate. So those are investment decisions. Then they have what they call consumption decisions. So somebody wants to go to Las Vegas. Somebody wants to go watch a Bronco game, or maybe not. Somebody wants to, fund some charitable cause or a non-profit cause that they feel strongly about, with no expectation of any financial return. So, finance really is about investment decisions. And, crowdfunding, the financial aspect of it is about investment decisions. And it is fine for individuals to engage in consumption. Like I think you heard that, people feel good about looking at various kinds of investment opportunities. It's exciting, it's a small amount of money. That's all good, but that's not what serious investment is really about. And that's what the commissioner, I guess, was referring to, that we have to not let people lose too much of their real investment wealth. So, you have to say now, if you're looking at some crowdfunding opportunities in Jonny's website or other websites and they look fun and interesting, that's fine, that's a consumption opportunity. Somebody wants to go skiing here. Well, maybe it's too early to go skiing, maybe not too early if you go to a basin. But somebody wants to go there. Those are decisions about what you like to do for fun. That's fine. But finance has nothing really to say about that. What we have to say is, how do you make your investment decision? And on that note, there was earlier talks about, people missing out on big opportunities, and we should get the common man to share in these upsides. It all sounds good. And we normally think about, say, the IPO of Google or Microsoft did the IPO way back when, and some of these more recent IPOs, these IPOs have gone up in value so much, thousands of times, and if only the common person could have, gotten into the IPO early on, and now the earlier version of IPO may be crowdfunding. Earlier on, we could have less inequality, and I'll get to what can really solve inequality. Or the evidence shows can. But so, if you're looking at investors out there, they have many choices of where to invest. They can invest in fixed income, treasuries, mortgage bonds. They can invest in real estate directly. They can invest in corporate bonds. They can invest in corporate stocks, IPO, like a whole gamut of investments. Now, it has to be the case that, in sort of, if they looked at all this or across many investors and over many years, the risk-adjusted return from all of these investments have to be the same. So the only way you'll get those really high returns or high expected returns is if you're willing to bear an exceptionally high amount of risk. And there's a lot of evidence in finance to back up what I'm saying, and I won't get into the details of that. Maybe my friend can educate you more out there. Doug, he also does this for a living. But so, you have to look at what I say, the vast amount of data out there in finance, that really the only way to get higher return on average is if you're willing to bear more risk. So crowdfunding, one is it may not be quite investments as we think of it. It's more consumption, and that's fine. No problem with that, but that's how you should treat that. Now, the other, I think, if I just take 2 minutes and because this issue has come up, indirectly and indirectly about income inequality. It's a serious issue, But it's not going to get solved by some making crowdfunding easier for investors, or I think it sounds good. The only things that have solved, at least according to the economic evidence on income inequality. So we looked at 200 of the largest U.S. cities. We got measures of rule of law. I think in a law school, it's good to talk about rule of law, though I teach in the business school. So cities that have better rule of law have more jobs growth 2, 3, 4 years later. Cities that have better rule of law have less income inequality 2, 3, 4 years later. So that's what the evidence suggests. It's not very flashy. It's not very, something to, you can really, the media wants to talk about too much. It's focused on things that we know matter. Now, this is obviously data on 200 US cities. We also looked at the 100.
Sorry, I'm going to pause you quickly just because
Okay,
I want to make, just for timing purposes, I'm supposed to have opened it up to the audience. So I want to open it up to the audience for questions now. I think we have a microphone going around, and I want to give the prerogative first to a student. So do I have any students?
Can I say one more thing very quickly?
Maybe I can just get hands going first.
I love this panel. This discussion has been so good, and I really, you've done an awesome job moderating it, and I've really appreciated the discussion, because it's actually brilliant for every one of you guys to know, because there's real debate and tension and discussion here, and I really I think there's kind of really good arguments on both sides, and so sorry for being, kind of a little combative maybe, but it's much more fun.
You're in law school. That's the name of the game.
Yeah, I'm not used to this. As an Englishman, I feel very kind of uncomfortable with this debate here, but
You'll just have to spend more time in law school.
yeah, I hope to continue the discussion.
Sure. All right, we'll give you the first question.
Great. Thank you all. Based on one of the comments from Professor Cable this morning, and then lots of elements of the panel tonight, it seems like just funds in general have a solution to a lot of what's talking about. The diligence challenges, the documentation challenges, the portfolio challenges are in creating portfolios. And as retail investors, choosing individual stocks, individual businesses, especially individual early stage startups, seems like a bad approach, despite the 5 minutes of diligence that you can do, or hours spent watching videos or whatever. I just wonder if equity crowdfunding has thought about creating, whether it's a portfolio approach where you can invest into a wide swath of these opportunities, and whether that's something that from the regulatory standpoint has been discussed, and whether you think that's a good idea or not.
Like a crowdfunding mutual fund.
Yeah, that's a great question. Regulation crowdfunding doesn't allow for that, so that you have to invest in individual deals and kind of pick investments one by one. Sweater, you should Google Sweater VC. So they're doing some interesting things around trying to create a VC, and it's kind of complex from a regulatory perspective, but really love the idea of retail investors being able to invest as LPs in VC funds and invest in an index and a portfolio as well as individual. And yeah, the analogy for me is Wefunder our tagline is literally angel investing for everyone. So we think angel investing is cool, and some of it is obviously to do what Todd did, which is browse through the companies, choose one you like and invest. But it might also be that your friend that you've known for 10 years that you would really, really believe in, and he's starting a company, and that this guy would run through walls, and you would, you really, really believe in him. The passion he has for this company that he's been thinking about for years, and he's finally taking a run at it. That might be the investment. And actually, the vast majority of investment volume on Wefunder is coming from people that the founder, the company brings, either people in their first degree network, personal connections, or customers of the business. Actually, a pretty small percentage is people like Todd that, find the company on Wefunder and then, invest through the platform. So it may be years and years of due diligence from kind of personal relationships. It's not always the kind of 5 minutes that you mentioned. But yeah, the analogy for me is Reg CF is angel investing, but there is some cool stuff going on with, retail investors, unaccredited investors in VC fund.
How much do you guys vet the companies before you list them? I mean, what is it purely process, or do you look
Very
at
little.
Okay.
Very little. So our philosophy is we're a pretty open platform. And so there's a lot of kind of required checks that we go through from fraud and compliance perspective. But in terms of, is this a good investment opportunity? And this is actually like the biggest kind of
merit review.
Exactly.
Yeah.
And this is the biggest kind of question for me. And, you know, I've argued with a couple of lawyers in the space because they will be looking at, you know, this issuer didn't file the annual report and the kind of, the technical compliance with the laws for me is actually not the biggest kind of concern. And you were alluding to this, Allison. The biggest concern here is like investor returns. And is this a good investment? Does this valuation make sense? And that for me is a bigger concern, more so than technically, you know, have they checked the compliance boxes?
I saw a hand over here.
I want to say one thing about the funding. First of all, but compliance is a really good red flag for actual
Totally.
bad returns.
We
But
have to do that.
Yeah, so it is important. But the point I want to just say one thing about the fund, the question about whether there should be funds in the space. And this goes back to my concern about data and not knowing. We don't even know what the average return. So what you would want to be capturing is some sort of index across crowdfunding, and we don't even know what those, we don't know if we want that or not because we don't know what those returns are. In the stock market, you can buy an index fund, you can look at, you know, decades of history and you can say to yourself, this is pretty much what I can expect over the next 6, 10, 15, 20 years. You can't do that. Doesn't mean you shouldn't, but I am saying hard to answer that question without knowing what the average returns are. And then to Sanjay's point, you know, the only way to, in general, just market forces, the only way to increase those returns is to increase the risk, period.
So just to touch on, to distinguish, it's an important point. So I think you're talking there about an index fund in RegCF. That's actually not what I was referring to. I was referring to a VC fund that has unaccredited investors as LPs, where the VC would kind of be choosing like who to
So like a
invest in.
hedge fund for...
I want to make sure that we get our audience questions. Yeah.
2 comments. Mr. Price, as an investor over 40 years, it's the rider, not the horse. I agree with you. Secondly, I think that David Hume confronted some of this when he suggested, and I paraphrase, in the 18th century, there is no rational action without prior emotional involvement. Emotion in human activity, and your professor of finance will bear this out, always rational action always follows emotional engagement.
And then did I see a hand here for a question? Yeah, please.
So I'm your entrepreneur here thinking, should I crowdfund? So happy to be here. I think this is absolutely fascinating. So I have 2 questions. And I don't know if there's data for the first, but I've known that historically female founders are more successful than male founders. And I saw that in the UK, at least, you guys have more data on this crowdfunding arena. I wonder if businesses that are crowdfunded if there's any data around them being more successful than traditionally backed VC businesses. And then my other question is, does places like yours work with potential people wanting to be put on the platform and say, hey, you're a good fit? Is there any data around the areas where you think that people, you said the democratization of things. Is it products that are tangible, crazy ideas, soccer teams? Is there any data that would suggest these types of things are much more successful on this platform than others?
Yeah, so on the first question, if you go to wefunder.com/PBC, we have some stats and actually Andrew kind of references in the book. But there's some encouraging data that some of the stats I gave earlier, percentage of dollars going to Black founders, female founders, states outside of California, New York, Massachusetts, are higher on our platform and on other platforms. It's not 50% of dollars on Wefunder going to female founders, but from from memory, it's 20%. So if kind of the current status quo is maybe 2%, we're at 20%. And it's actually the same on the investor side. So I think I Googled gender breakdown of angel investors, and I found 85% of angel investors were men. On Wefunder, high 60% of our investors are men. So it still skews towards men, but certainly much more balanced than kind of conventional angel investing. On the second question, the simplest answer, I could wax lyrical for hours about this, but in terms of which founders are the best fit, which companies are the best fit, simplest answer, consumer facing. One, because your customers then are potential investors, so you can go to your customers to invest. And then secondly, Oak and Eden probably gets more value from Todd, being the brand ambassador on this panel than an enterprise SaaS company. So you kind of, B2C companies get a little more value from recruiting an army of brand ambassadors. But we've done many B2B companies, biotech companies, all industry sectors, but in a one sentence answer, consumer facing.
Thank you. Brad, I think I saw your hand.
Yeah, thanks. Thanks. So there's one of my favorite lines of a friend of Silicon Flatirons was he said, I don't always understand what's being said on those panels, but I always understand a good fight. So no need to be apologetic. That made for a terrific conversation. So I got three kind of comments / questions, or I'd welcome reaction if any of these things catch your attention. The first is, one is to the point about the difficulty of tracking outcomes in crowdfunding. I just note that comparatively, angel investing is notoriously difficult to get accurate data about returns of this asset sector. And yeah, there's guesstimation, but it's really hard. And it occurs to me that, while there's conflict of interest challenges with, say, Wefunder or a platform taking an investment in this, it might be a way to representatively track outcomes over time in a pretty interesting way. Second is that traditionally, the outside investment, whether it's an angel or a venture capitalist, bundles expertise with the capital. And I think an interesting trend in the world of entrepreneurship really over the last 10 to 15 years has been the rise of networks that sort of help that unbundling to a certain extent. So whether it's accelerators, which yes, take some investment, but at least allow for a lot of outside expertise, formalized mentorship programs, whether it's as part of a university or a community. How does that inform your thoughts about the possibilities around crowdfunding and the possible unbundling of the expertise from the capital? And then the last piece is, and I'll come back to your point about a SAFE being like a 3-page agreement. Startup investment contracts are really pretty thin little documents from a legal perspective that tend to be augmented by all sorts of reputational and social norms. And that tends to work really well in some communities, especially something like Boulder, where if an entrepreneur acts opportunistically and badly, that gets around. The same thing in terms of an investor. If she acts that badly, that gets around too. What are you seeing in terms of reputational work in the crowdfunding world?
Yeah, I can maybe speak. I think my answer to your second and the third points are maybe kind of similar. One thing I'll highlight is that it's usually not an either-or thing. And we are really, really pushing it hard for it not to be an either-or thing. By either-or, I mean, accredited and institutional investors or unaccredited investors. So I think there can be a misconception like, oh, I'm not going to go the institutional route, I'm going to go the crowd route instead. Some of the best companies on Wefunder actually, like Oak and Eden that Todd invested in. Substack's an example, Mercury Bank's an example, Replic's an example. Mercury raised 120 million Series B from VCs and then opened up $5 million to let their customers invest. And that's awesome to have both, right? Both the VCs and the customers and community and unaccredited investors. And kind of to your second point on the value add, right? I don't think that, a founder can send an update to their Wefunder investors and say, hey, does anyone have any ideas about this? Or, we would love some product feedback if you guys think this product. So there can be kind of some advice. But at the end of the day, average investment on Wefunder is $1,000, median's $250. So if someone's investing $250, like
they just don't have the time to, they're not going to take a board seat, right? So for me, like if a VC invests, yeah, maybe they've trodden the path before, they have some great advice, they take a board seat, they invest their time in giving that advice. That's kind of less of the value prop of kind of, community round funding, RICCF funding. The value prop for me, for the founder, like for Oak and Eden, is you recruit an army of brand ambassadors and thousands of loyal customers.
I'm gonna pause real quick,
Yeah.
just run out of time, and I'll make sure Todd.
Yeah, just 30 seconds. One thing I thought was interesting is a lot of these, I just know the consumer-facing ones, they have these perks that you can get, and almost always one of the perks, if you invest enough, is you get to have dinner with the founders or dinner with the management, right? Which is kind of interesting. I think it was out of my price range, like 25 grand or something for Oak and Eden, but you get to like go there and like have dinner with these guys, right? So there's a sense that I think they're obviously tapping into some sort of reputational aspect of it. Second thing I would just say is the last thought, which we've talked a lot about the returns, and I understand this is about investment. I do want to make the point that my perception is that people are not investing in a lot of these companies purely for the economic returns, right? People invest in the New York Stock Exchange for the economic returns. A lot of these companies, I get the sense people are investing because they think they're doing good. And they're not investing purely for the economic returns. And in some sense, they don't really kind of care how much money they make off of it. So as our empiricists are going forward, and I'm not an empiricist, the empiricists are going forward, I would just ask that people keep that in mind, which is I don't think the financial returns measures everything that these guys are doing as a public benefit corporation, for example. They're meeting a need for people that isn't quite consumption. It's not quite investment. It's backing a project that they think is good for the world in a different way from just making a charitable contribution. And the financial return on that, I think, doesn't measure everything, is my sense.
Thank you. Well, we are at time. I had hoped we could jump into more about the future of investment crowdfunding. I personally am hoping there will be an entertainment value. I hope we can see one day have Shark Tank crowdfunding edition. We'll see what happens. If you all could give a quick round of applause, please, for this fabulous book and this fabulous panel.